Hi everyone, Harry here again with the StockMarketBasics.com. Thanks for tuning in. You're about to see the introduction to the stock market video number 4, Why Companies Issue Shares. Companies need money for a variety of different reasons, such as expansion, acquisitions of other companies, big capital purchases such as land, buildings, or equipment, or even to meet large orders placed by customers. As the old saying goes, it takes money to make money. Ultimately, companies need money to run and grow the business and must find a source for the money required to do so. This is also known as capital. Companies have two main options when looking to raise capital: debt or equity. Debt is a bond, loan, mortgage, line of credit, or other type of credit facility. It could be either secured against an asset owned by the company, such as land or equipment, or unsecured. The better the company's credit rating and perceived ability to pay, the safer the loan is going to seem to the lender, and the borrower will be able to find better interest rate. Debt is an obligation to make regular payments which affect a company's future cash flows. The company that borrows money will need to make regular payments, including interest, on the debt, as well as pay back the entire principal, which is the amount borrowed, eventually. The interest itself is tax deductible, which may be a benefit to companies looking to reduce their tax liability. The other option is equity financing. Equity financing is when a company issues shares in the business for sale to investors. The greatest benefit of equity financing is that it doesn't come attached with an obligation to pay. The company can issue and sell shares and use that money without worrying about monthly payments or loan due dates. Financing with equity conserves cash flow. On the downside, issuing shares means that the company is giving up future upside potential in the business. To illustrate this point, let's look at the question of debt versus equity from the perspective of a company that needs to raise capital. If the business is worth $1 million and the owner sells half of it, the owner now has half of $1 million. If that company takes off and is now worth $10 million, the owner still owns half of the business for net equity of $5 million. If, on the other hand, the owner borrowed $500,000 and the value of the company took off to $10 million, the owner still has $9.5 million worth of the business. $9.5 million worth of the business. Now, looking at this, you might think, well, why would anyone ever want to sell shares in their business? They're capping their upside, and they'd be losing out huge if the business takes off. Well, you may not be able to get a loan, or the interest rate you can get on a loan is high, and monthly payments would limit your ability to expand or even keep running. You might want to go public to increase your company's profile or exposure. Maybe you want to reward and incentivize your star performers with stock options. It makes sense to give up a stake in the business in order to attract talent that will help you take the business to the next level. Ultimately, the decision comes down to cash flow and availability of capital through the two main sources. Most companies use both methods to one extent or another. Debt is usually used for working capital, and shares are issued to cover the large capital outlays. After all, it makes sense to use other people's money if it is available to be borrowed at no cost.